Okay, so welcome everyone to SAM virtual seminar series. We're super happy to have Sumudu Watugala as our presenter today, and she'll be presenting credit relationships, specialization, and fragility in hedge fund broker-dealer networks with Matthias Krutley and Philip Monin. And we're also super happy to have, in addition to a regular panelists, these additional panelists who graciously agreed to join the talk. They'll play a more active role in forming a more lively audience. And let me remind everyone the format of the talk. The talk is 1 hour, followed by 15 minutes of Q&A. During the talk, please feel free to post clarifying questions to the Q&A. And during the Q&A session at the end, feel free to post questions to the Q&A or raise your hand in the in the Zoom, and we'll unmute you and have you ask the question if you'd like. Let me remind one of our last talk, which is on May 11th. Taiwei Hu will present Breaking Up with M, Cashless Limits Under Limited Commitment. So with that, I'll pass the floor to Sumudu. Sumudu, please take it away. I'm gonna stop sharing.
Okay, let me share my screen. So first of all, thanks Bachimeg for inviting me to present in this really cool series, and also for that introduction. So when Bachimeg reached out to me, it just so happened that Matthias, Phil and I were thinking about matching in this market. So the paper, broadly the paper I'm going to talk about is on credit relationships, specialization, and fragility in hedge fund broker-dealer credit networks. And we've been thinking about how specialization and how hedge funds and broker-dealers, how they match within this market and how that affects sort of the network structure and how stable things are during crisis. So the caveat I wanted to give is that so we've been there were certain tables and results I couldn't clear in time for the presentation. So I will spend a bit of time talking about some related work we have that's already published that forms the stylized facts, and then talk a bit more about the conceptual framework or simple model we have of this market, even though ultimately the paper will be predominantly an empirical paper. Okay, so let's get started. We all know that hedge funds are important for market efficiency and stability. So if you think about the quintessential arbitrageurs in models with arbitrageurs, hedge funds play that role in practice. In their trading, they identify and exploit mispricing. So think about sort of spread trading, where they are betting on the convergence of certain spreads, and this kind of activity effectively provides liquidity to markets. So in general, the stuff they go long and the stuff they go short, they're going against the sort of market flow, and they provide market support in this way. And on top of that, even more than sort of traditional liquidity provider role, following the global financial crisis, there's different regulations that have constrained the activity. There are papers that have found that it has constrained the activity of traditional sort of bank-affiliated broker-dealers. So hedge funds have an increasingly prominent role in many markets, especially over-the-counter markets. So understanding the constraints to their activity and the externalities of their activity is crucial from sort of a financial stability perspective, or just purely understanding how markets are functioning. Hedge funds typically use extensive leverage and have illiquid investments. So this is quite a contrast. So even if you work with asset managers, this is very different from, say, if you think about mutual funds or money market funds or ETFs or anything like this. The extent to the use of leverage and how illiquid the investments are, and in fact, how concentrated the portfolios can be, is significantly different. And so this leverage comes predominantly from either explicit or implicit leverage obtained from broker-dealers, and they're often bank-affiliated broker-dealers. And so this is a key channel through which shocks can propagate between banks and sort of the shadow bank sector. And this is why you find policymakers and regulators pay attention, and it's sort of important to understand. So the distribution and depth of credit relationships, how they're formed, and why what factors affect the market structure, it can introduce contagion and fragility. But we're going to focus on this paper is sort of a bit of a different flavor in that we're going to look at specialization in broker sort of the how the relationships with hedge funds can induce specialization and how there are benefits and costs to this specialization and whether there are externalities or try to understand where externalities might come from for overall fund welfare and systemic fragility. So broadly, we're going to think about how the trade-offs to specialization affect hedge fund broker-dealer matching and what the implications are for the structure of the market at a very basic level. I have these headlines to sort of motivate how important this sector and questions are. I don't think I have to convince this audience, but let me just very quickly talk about what I have here. So the incredible untold story about how the financial world almost ended and then how LTCM approached the edge of the abyss. So these are some headlines from Wall Street Journal, Bloomberg, New York Times, and so on. And so this was so long-term capital management collapsed in 1998, and this was sort of the first indicator for how significant large hedge funds can be for market stability. But however, it's not the case that, following the post-GFC regulations, it's not the case that we haven't seen any major crisis. In fact, the rest of these headlines are all, from 2020 onwards, right? So this is from New York Times. Hedge fund bailout highlights how regulators ignored big risks and how a little known trade upended the US Treasury market. So these are headlines following sort of the March 2020 Treasury market turmoil, where there was this idea that hedge fund activity had a big role in the instability experience, like the unprecedented instability experienced in US Treasury markets. And then these two are even more recent. So about Archegos, technically a family fund that had very similar activity to hedge funds, where the collapse of Archegos generated over $10 billion in losses to a set of major prime brokers. And it was one of the proximate drivers, one of two major hits that Credit Suisse suffered before they ultimately, effectively went out of business or was merged into UBS. All right, so the plan for the talk is I'm going to establish some stylized facts based on primarily other work I have with Matthias and Philip that's already published on hedge fund broker relationships and specialization. And we're going to formalize these stylized facts in a conceptual framework. Hopefully this will organize ideas regarding equilibrium and outcomes and externalities. And then ultimately, we want to harness the granular data that we have worked with and continue to work with, so the confidential regulatory data, to empirically analyze. So we have the network as a given, we shock it and see what happens to understand what kind of equilibria we're in, what kind of shifts we can see when parameters change. Okay, so what do I mean by trade-offs to hedge fund broker-dealer relationship formation? So from a hedge fund perspective, there are both costs and benefits to specialization versus diversification. What do I mean by the benefits? Okay, so when a hedge fund has activity or connects or matches with a broker that already has a significant fraction of clients that are in similar trading strategies or are trading in similar asset classes, there can be benefits for this hedge fund by sort of clustering with same style hedge funds. So this can come from the fact that the broker can have infrastructure in place for risk managing or trading particular asset classes, right? So in fixed income, so treasuries or corporate bonds, swaps, and so on. And in addition, so where some of these benefits can come from is, so there are papers that have looked at these ideas. There can be information advantages. So there are papers that have shown that there seems to be transmission of information from either existing clients to other hedge fund clients, or let's say you have a bank affiliated broker dealer, they are either doing an IPO or a major syndicated lending deal that's not public yet. And so papers like Kumar et al. Have found that there's transmission of information that gets to hedge fund clients. And internalization and sort of lower search costs, you can when you are taking a lot of margin or leverage and you're trading for a broker dealer, when you have a large set of hedge funds doing similar type of trading or in similar asset classes, you can internalize that flow in the sense that if there is both long and shorts coming from different clients, it can be netted out such that the inventory cost can be much lower. So my co-authors, Matthias and Phil, have a separate paper that looks at how in the March 2020 crisis, it was possible to for brokers to reduce their search costs given their connections to hedge funds. On the cost side, I think this is more straightforward. We have, I mean, I showed the headlines, and in general, these tail events or fragility risks manifest in headlines, right? So the counterparty risks that can come from having sort of clustering or concentration, if in particular, if you are clustering with the same broker and you have overlapping portfolios, they can be a double hit in sort of deleveraging hits in at the same time that your portfolio assets are going down in value as well. And then fire sale risk. When I get to stylized facts, I will go into more detail about what some of these papers have found. But this is just to give you a flavor and sort of a preview of what we're thinking about. Should I just call on folks? Okay, Jay, did you have a question?
Yeah. How much should I think of this as an extensive margin versus an extensive margin? In other words, like I can form a relationship with a dealer who specializes in the same trades as I do. Or if I'm doing multiple different trades, I can just route the ones the dealers specialize in. I'm guessing one is going to be easier for you guys to observe than the other. Uh,
Well, I mean, we can look at the connections and also that's a great question, and we have thought about sort of the two differences. We can see the connections already made and how the allocation changes within those connections already made. And so we do find evidence of sort of preferring specialization or same style clustering, both on the intensive and extensive margin. Yeah.
gotcha.
So it
Gotcha.
is true that it's not often that connections break or newly form with these hedge funds, but where there is changes, it tends to, in general, outside of I will talk more about this, but in general, it favors specialization. And then within the connections you already have, the allocation seems to take similarity or specialization into account.
Gotcha. Thanks.
Okay, great. And so what sort of the idea we have here is that a hedge fund can fail to internalize the impact of their choices on overall agglomeration benefits and overall systemic risk, right? So there's this idea that when a fund clusters, borrows from or does activity with a broker that has sort of more style clustering, your choice of joining this broker also impacts your peers. And so a fund can fail to internalize this impact, and so this can create an externality. So individually optimal borrowing decisions can lead to aggregate suboptimal outcomes. And so just to give you a flavor, I think the key or sort of surprising thing, which is sort of obvious when you think about it, is that because the externality can be positive or negative, right? So you may fail to sort of internalize the benefits of agglomeration in addition to the risks of to systemic stability. It's possible that the market structure under concentrates or over concentrates relative to an optimum.
Is there
Yeah.
anything special about the hedge funds here in terms of the inefficiencies created? So it seems that this type of argument could apply to many other of relationships. Is there anything special that seems particularly worrisome about like hedge funds that we should be focusing on it?
Right. I mean, we also think about this quite a bit. I think the nature of this market is quite unique. So what do I mean by that? Like when you go back to the benefits, I mean, you don't really have this level of sort of first order benefits in any other, I mean, not many markets can I think of, right? So if you think about a traditional bank and a firm, it's not like, I mean, yes, you can have sort of lower cost borrowing, but it's not first order to a firm. You're not going to make necessarily, you're not going to get information that helps you build a better computer necessarily, right? So this specialization benefits are particularly strong here. And so this can be discounted if you just apply what you think about in other credit market settings. So the fact that, unlike say ETFs or mutual funds and other asset managers as well, these advantages can be particularly significant, like orders of magnitude higher because of the nature of their trading. So alpha seeking activity, very levered, working with illiquid, sort of hard to trade assets, and then weathering crisis, right? Because they're not regulated. You really have to. It's sort of like a Wild West in that you need to set up your structure such that you have to survive on your own, despite that headline about bailouts when the entire system is going down. So I think it's like first order, the benefits from same style clustering can be very significant. And so I think that's a difference. Very good. So just to, again, like have a visual about where we're going to go. So we're going to have a very simple model of endogenous specialization and systemic risk. And I've talked about market structure and sort of specialization, same style clustering and so on. And I have some pictures, very stylized, to show what we're thinking of, right? So when I say broker, broker-dealer, or creditor in this market, I'm sort of interchangeably using this. So here, let's look at this first subfigure. We have two brokers and two representing two types of hedge funds, right? So equity hedge funds and fixed income hedge funds. And so here is where we have an example of a market structure where here you have full style segmentation. So where equity funds only borrow from one broker and the fund fixed income funds borrow from the other. And here's an example of like full diversification. So you can think of these as sort of like the two extremes. And you can also have full agglomeration, sort of in theory, where one broker gets everything. And so this is the kind of type of structures and ideas we want to think about when we're thinking about same style sort of specialization and systemic risk. Okay, so on the empirical part, we are going to use data from the forms PF and ADV. That's so form PF especially is a confidential regulatory data set. ADV is a public data set where SEC registered investment advisors managing private funds have to file both. As I will talk about, this gives us a very granular view into hedge fund activity, characteristics, their credit relationships, and so forth. And so for us also, there's trade-offs. So we get a lot of information, but it is also kind of very restricted data and takes a while to clear results and so on. Why we need this data is we're going to, in our empirics, have a granular measurement for sort of same style clustering in that we're going to look at a vector representation of a hedge fund's either strategy style allocation or asset allocation. So look at the actual portfolios and look at the cosine similarity with the existing broker's other client base. So this is going to give us an idea about.
Can I ask a clarifying question? So when you
Yes.
measure these credit relations, do you just look at whether the fund and the broker or dealer has a relation or not, or do you also take into account the cost of credit? Because I think the previous argument also applies for the cost of credit, but the implication for systemic risk can be different.
Yes, so that is a great question. So we will predominantly look at the amount of credit and how that changes. We have some view into how the cost of credit changes in terms of how much collateral you post and the maturity of the credit, sort of at aggregate fund level. And so that gives us a pricing, a view into the pricing as well. Okay, and so
another question, Subodhu?
Yeah, Isha?
Clarifying question. So you were talking about market segmentation across market types like equity versus fixed income. Can there also be concentration within each segment? So will it matter if the equity market segment is more concentrated than the fixed income market segment?
That's a great question. So you're thinking about like if one fund is particularly big and so on. That's an angle that a framework is generally enough to, I guess, we can look at extensions, but right now we're just thinking about sort of clustering. When we get to the framework, I think it'll become clear. We are thinking about sort of aggregate exposure. So I think we do account for that even in the baseline setting. Yeah. Okay, great. And so we're going to exploit a major shock to the network, specifically the 2021 Archegos collapse. And in empirics, we want to understand whether credit relationships tend towards specialization in this market, what type of funds exhibit stronger preference for specialization, and how this tendency to specialize changes after sort of this salient exogenous major shock. In our empirics, we find that hedge funds indeed do tend to specialize. So funds borrow from creditors with similar hedge fund clients. The average similarity of a fund that's with a connected creditor, so one they're actively borrowing from, is twice that with an unconnected creditor, right? So they tend to have higher activity with and more connections with creditors that have high similarity, as in the client base exhibits sort of high strategy similarity or asset similarity. And so these large hedge funds can have multiple credit relationships, and their highest similarity relationship is with their prime broker. And this makes sense, right? So from their prime broker, not only do you borrow, but there's a host of other services you obtain as well. And these tend to be the most specialized relationships. And then it's highest for funds with which would benefit particularly from specialization. So ones that where the information advantage or search costs are particularly a big deal, right? So you find that they tend to specialize more. And going back to Jay's question earlier, we find that not only in the extensive margin, so active connections, we find that in the intensive margin, so in reallocation as well, it is higher with high similarity creditors. And so when we analyze the Archegos shock, we find that, yes, indeed. So I said it's a major shock. It's kind of exogenous to this set of hedge funds in that it was not necessarily a shock that came from, say, a broker collapse or anything like this. But yeah, so what we find is that these creditors that were affected or by this Archegos collapse, they significantly cut lending, both in the intensive margin, but also they reduce the number of connections. There's rationing, so creditors seem to retain, so brokers appear to retain and cut relatively less credit from high similarity connections. So under stress, they seem to favor they're more specialized hedge funds, and you can imagine that these are the most profitable, but also like sort of lower cost margin clients for them, and they tend to shield them more during a crisis. And so the magnitudes are imply that if you have sort of perfect similarity, so cosine similarity can go from 0 to 1, you're in effect fully shielded from the supply cut. But in actuality, you don't have a similarity of 1, so everyone experiences a credit supply reduction, but you are particularly you're less affected if you line up sort of have a stronger match or you have high similarity with the broker. So we think of this shock as as increasing the perceived sort of fragility risk. And so we find that following this shock, the connections exhibit greater diversification. So there's a sort of move away from highly specialized relationship to some extent.
So can you speak a little bit more about that? Like,
Yes.
how fast is this substitution? So one way of thinking about this, I guess, is the shock to a broker is quickly replaced by another one. You just move to the next guy.
Yeah.
And at the end, it doesn't affect so much the activity of the hedge funds overall. It's just that, well, now I have to get credit from the next best guy instead of the first one I'm used to.
Okay. So this is a great question, and I'm not going to use this shock to explain, go into detail about that answer too much, but I will allude to a published paper where we do look at a different shock, and you can see this as well. But the point is that the intensive margin effects are very strong, and you see it like almost the next quarter, you already see it in that. So you can reallocate within your existing connections more. The extensive margin is a bit mixed, and so we want to look at sort of a longer horizon, but there also we see sort of smaller effects. But certainly the intensive margin reallocation is quick, and it happens right away. In terms of being able to substitute and so on, I'll refer back. I'll come back to this question when I talk about a previous paper. In terms of stylized effects. Great.
Can I also ask a quick two clarifying questions? I guess one is following up on the question that just came. Like, what in the data identifies like how steep the cost and benefits are in, you observe people switching, but what is telling me how much of a loss I have? What is, that would have to do with rates that you observe, that you pay, things like that, these various benefits. So do you observe those, or do you just observe they move? And then it's unclear whether it was a marginal benefit of moving or a very large benefit of moving.
So this is something we are able to do, and this is a great question. I won't have results to show you on this shock today, but we do see returns at the fund level. We do see sort of maturity of borrowing. We see how much collateral folks are posting, so aggregate amount of credit. How much credit are you getting from one particular broker dealer? So there are a host of aggregate sort of fund level measures we can look at to see how significant it is at the fund level. Yes.
And then just when you said similarity equals 1, who's equal to whom in this case?
I have a nice picture later on, but
okay, then defer. Go ahead.
Like we're at like a halfway point, but what I mean is that we're going to measure similarity. So we'll have a fund creditor sort of time level measure of similarity. So what is this? So for a particular fund, you look at a broker and the broker's other clients. We can have a vector representation. So these are large funds. They have allocation to about 50, like a dozen different styles. So we have a vector representation of their strategy allocation, and then we look at the cosine similarity, right? So a perfect match would be I have like a 70% fixed income and 30% equity, and the broker's client base is also on average 70% fixed income and 30% equity, and then you would have a perfect match with that broker. So
I see. So, but then it's like the representative fund, and that guy doesn't get any contraction in lending. That was your result, right?
Similarity one is not the representative, right? So average similarity of existing connections are about 0.6. Right, so similarity one is like
I thought it was
100%.
How similar you are to the representative, but then I didn't understand your response. I thought it was how similar you are to the typical fund of the broker?
Yeah. No, I think like, it's the maximum possible similarity with your broker, right?
With the funds
Of
of the
the
broker.
representative. I see what you're saying, but in general, we don't see ones. These are large brokers, and like there's a lot of so the average is like 0.6 of connect.
I just
with your-
conceptually wanted to understand why there would be no response of somebody who looks like the representative or typical, right? That was one of your results, which was very striking. If you look like you
No,
have
so
a similarity with
the
one.
way we interpret this is that, so going back to the preview, I don't know what the preview is, but this is sort of like if you had the maximal sort of the strongest possible similarity with the broker, then you're fully shielded, but typically you're not shielded. So you would have experienced some reduction in credit supply from the affected creditors. That's the result. Okay, so I'm gonna now take about a bit of time to talk about what we already know and what we've established in previous papers. So because this is with Matthias and Phil as well, I can talk about these papers that use the same data, and they weren't on the same question, but in the process of answering a different question, we found we sort of established multiple things about multiple facts about specialization benefits and costs to concentration. So these two papers, because they also use confidential data for a long time, they were not circulating. So if you haven't seen it and you work in this area, I highly recommend that you take a look because these are cool papers. So the first one is from 2022, published in 2022. It looks at, it's called Life of the Counterparty, and it's looking at, it's the first to establish certain facts about this credit market. And then the more recent paper looking at that March 2020 Treasury market shock I talked about. And as I also already alluded to in response to multiple of these questions, the hedge fund broker-dealer credit market has distinct characteristics. So you can have your favorite sort of firm bank or other credit market in mind, but there are special features to this market that require sort of taking seriously. So the borrowing that hedge funds tend to do is significantly over collateralized. What do I mean by that? The assets they post as collateral is worth more than the leverage they obtain. And for in general, this is primarily with rehypothecable securities. So the collateral that hedge funds post, the broker can use in their own borrowing, kind of repledge and in their own borrowing. And then another distinction is that the collateral resides with the broker. So think about a firm borrowing from a bank. You can, it's not, so if your collateral is your factory or your tractor or something, it's not that the collateral resides with the bank. And if the bank collapses, you lose access to the collateral. Whereas here, the collateral typically resides with the broker. And so broker fragility is a particular concern. So broker collapse is a particular concern for hedge funds.
So, Mudo, like, just one question on collateral. So you mentioned before, like the results on specialization. So how much of that's driven by collaterals? Like brokers are specialized in collateral types, and then if I do trades that rely on the same collateral, so then my borrowing is going to be concentrated, or is this concentration on the hedge fund itself? Or even if your hedge fund deals with very different collateral, is still concentrated in the same type of brokers?
I think I'll have to think about this, but I mean, certainly concentrating from with a broker that deals with the same type of collateral can be particularly beneficial. So I think the specialization benefits we're talking about would capture that as well. So this idea of internalization and sort of lower search costs and expertise matters a lot more. Yeah. So we show that hedge fund repo borrowing in particular is predominantly bilateral and uncleared. So typically when folks do analysis on repo, there's a lot of focus on, say, tri-party or cleared repo. But in this market, which is, there's significant repo borrowing happening, hedge funds are predominantly borrowing or doing repo activity bilaterally and in uncleared markets, which means relationships matter. And so from the perspective of these hedge funds, they tend to have one or more broker relationships, and the average relationship is really significant to a fund. So on average, 30% of a borrowing of a hedge fund is from one broker. The median is 20%. On the reverse, so large brokers can have up to like hundreds of fund relationships. And so for the average fund, the borrowing is about 2% on average of all lending of one prime broker, and the median is like 0.3%. And so this motivates some of the setup that we have in the conceptual framework, in that one hedge fund is not that important to from a broker's perspective. So what do we do in that life of the counterparty paper? We look at a particular shock so that's in the fourth quarter of 2015 to the fourth quarter of 2016. Deutsche Bank experienced a significant liquidity shock. So this is showing in the red line the CDS spreads of Deutsche Bank compared to the average of all prime brokers, all top 10 prime brokers, and the average top 10 prime broker and the average European prime broker during the same time. So they had a idiosyncratic significant shock in a way that, to an extent that, Bundesbank came out and said, we will not bail out Deutsche Bank. I mean, that was sort of the instability that they were going through. And so here we use this shock to understand whether, so this is post-global financial crisis, whether hedge funds run on their broker. And so as has been theoretically posited, and you might intuitively expect, given how the Lehman collapse affected hedge funds. So what we find is that instead of hedge funds running on the prime broker, what happens is that the prime broker cuts credit supply. So this is showing again for the same set. So the red line is the hedge funds that are the borrowing from the lending from the affected prime broker. So they cut their lending activity by over 50%. And so going back to this question about whether they were able to compensate. So hedge funds didn't run on the broker that was going through a liquidity crisis. The credit supply was reduced. And we find strong evidence of imperfect substitution. So the lost borrowing, even by these large hedge funds with multiple broker connections, they were not able to perfectly substitute even after multiple quarters. And so they subsequently have lower aggregate leverage, so explicit leverage, and their credit terms worsen. So the point being that if they have a significant relationship that a broker that suffers a shock, this can have aggregate fund level effects. And so from a portfolio market perspective, these affected funds compensate for the decrease in this balance sheet leverage by increasing the overall portfolio risk, by boosting their embedded leverage and implicit leverage to compensate for this loss in explicit leverage. So they have higher portfolio liquidity subsequently, higher embedded leverage via higher beta stocks, and they boost their derivatives exposure. So they kind of take on more risk. So just to sort of put all of this together, the stylized facts are that there are specialization benefits, and this can manifest during crises in particular, where credit rationing can favor the high similarity or high specialization hedge funds. And so this is something we also show for the repo borrowing in March 2020 for treasury trading funds. Repo dealers, so this is relationship lending, and it also favors, on top of that, the specialized clients. There are other papers, so Ching and Kang and Kumar and co-authors show that there are information advantages. So there seems to be information flow between hedge funds that are connected to the same prime broker. In addition, there seems to be information flow from other parts of a bank-affiliated broker-dealer's business to the hedge fund. And there's evidence on internalization and search costs. So I've mentioned a couple of them already. On the cost to specialization, I think this is sort of more straightforward, because this is what we have thought about for quite a bit during and following the global financial crisis. And so broker dependence and fragility. So George Aragon and Phil Strahan have a paper that looks at what happened after the Lehman bankruptcy. So hedge funds lost access to the collateral. They faced severe funding constraints, and this had market impact as well because they had to scale back the trading in these markets, and it generated significant illiquidity. So these funds suffered large losses and had higher probability of liquidation. And in a similar vein, there are other papers that show that broker distress can be a significant cost. This is a really nice paper. I don't know if any of you remember this StatArb sort of crisis or major instability that happened in August 2007. So Andrew Lowe and Kandani have a paper, What Happened to the Quants in August 2007. So this was a really kind of clear case study of cross-market contagion, that a large multi-strategy fund suffered losses in subprime markets. They then delevered and sold off sort of a relatively more liquid part of their portfolio in equity market long. So this affected other equity long short trading strategies, specifically the quant funds. And so it triggered a rapid cascade of forced deleveraging among funds holding similar overlapping portfolios. So this had an amplifying impact.
So Madhu,
Yes.
maybe you're putting this under one of the other categories, but I remember that one of the things that was said after LTCM was kind of no broker actually knew what the total exposure of LTCM was or what the margin that was due to other people was, which seems to be like another financial stability thing, but this one's in favor of consolidating, right, rather than breaking, rather than diversifying.
Yeah, I think like the LTCM example is we haven't really thought of things from a broker perspective as much, but it is true that, I mean, that could be a source of the externality, right? So even if you would like to take into account the sort of aggregate impact of your choices, this information might not be available to anyone other than a regulator or a social planner. So in the present day, given the existence of Form PF, LTCM-like event should be able to be monitored, and because LTCM would have reported to Form PF, but then you always have these sort of hidden spots. So Archegos is technically not a reporter, so it's not a hedge fund. It's only a family office. So if you're just one family like trading for yourself, technically you don't have to report to anything to regulators. However, Archegos was also fraud, right? So that already, like, I think Bill Huang, so the founder, I think either has prison time or major. So we're not talking about fraud here, where I think they particularly lied to their brokers about the extent to how much of the same positions they were taking with multiple other brokers. So that's a different aspect, yes.
I also just mean that could be an advantage of information, right, for the hedge fund.
Yeah. That's right. Yes. Yeah. Okay, so the goals for the model is, I don't want to overpromise. We're going to try to capture these stylized facts. I'm happy to take your feedback on this. So what are the stylized facts? There's specialization benefits from same style clustering at a broker. There's broker fragility effects, and they're increasing in total broker exposure to hedge funds. And then there's fire sale risk from same style crowding. So these are going to be sort of like the three main channels we're going to capture in the framework. We want to characterize possible equilibria and externalities and organize ideas and discipline subsequent empirical analysis. So in the interest of time, I'm going to speed up a little. So what's the environment? Very stylized. We're going to have two prime brokers indexed by 1 and 2. We will have hedge funds of two styles, equity and fixed income. And so the total mass of type I funds is going to be Ni greater than 0. The allocation is, so MIJ would be the aggregate financing exposure of type I funds at broker J. And so capital M is going to represent the total exposure at a particular broker. So the feasibility is that all the exposure of a particular type has to be allocated to these two brokers, right? So for a particular type, the amount of borrowing from broker 1 and broker 2 have to add up to the total exposure of that type. So this is going to be our utility function. So what is this, or payoff function? So a type I fund with an exposure MIJ at broker J is going to obtain this utility. And this is going to capture this three-way trade-off, right? So the first one, the specialization benefit, is the benefit from same style clustering. So I hope I sort of convinced you that there are benefits to same style clustering that can come from internalization, information, tailored infrastructure, preferential credit rationing under stress, and so forth. And so this is increasing and concave in MIJ. So specialization benefits, your broker's expertise, or the benefits you're getting from this clustering is going to be increasing in how many other funds of the same type are with this broker, and it's going to be concave. It's not sort of.
Sorry, so exposure is the amount the fund is borrowing from the broker?
Yes. Yeah. And then the second term is systemic risk. So this is the exposure to broker-wide shocks. And so the idea here is that systemic fragility is more severe. So sort of the amplifying cycle is more severe if the broker has a larger exposure to the hedge fund sector. So this is not a same style effect. It is sort of what is the total exposure the broker has to the hedge fund sector. And that's going to be increasing and convex in size of total broker exposure MJ. And then the third term is the fire sale risk that comes from the cost of correlated asset liquidation. So the idea there is that if you have a shock that hits the same style, this deleveraging shock can propagate through your broker to you. And so this correlated asset fire sales and the deleveraging shock together can amplify when there is same style crowding at the same broker. So this is our sort of capturing our trade-off. We have the benefits and then the sort of systemic or fragility risk, and then the fire sale risk here.
Sumudu, so
Yes.
the BI is specific to the fund. One thing I'm struggling with is if I'm hedge fund and I'm borrowing from some broker, I don't know, do I know in reality who are the other hedge funds and how large the broker's exposure is?
So it is specific to a style here. BI is a style. So as I said, like so different styles can
fixed
sorry?
fund. Equity versus like fixed income, right?
That's right. Yeah. So I mean, typically you sort of word of mouth will know what kind of prime brokers or other hedge funds are large hedge funds using, or prime brokers might use it in their advertising and when they're trying to get clients. But in fact, I'll relax this and only talk about a very symmetric equilibrium. So, but this is to capture the idea that you could have greater benefits for certain types than others, and you can have that affect the market structure. And we do see that in the empirics as well.
So, sorry, just the functional specification for just a clarifying question for now. The BI, same component here. The BI of MIJ, it says here these are the benefits from same style clustering. Presumably, if I'm going to a broker that has the same style, I'm going to a broker where other funds with the same style go, right? And so why is this not an argument of MIJ, comma, M other funds, comma, J?
So like capital M, you mean?
The first component, it says, is specifically about benefits, the BI. It says benefits from same style clustering. So I would have expected.
So right. So when you are choosing if I am connected to broker J, so I'm a type I fund connected to J, my benefits are going to be from connecting to J is the specialization or style benefits are related to how many of that same type are already with J. Does that make sense? Or how many I expect to be with J.
Okay. And so that therefore I would have expected the BI function to have an argument that has to do at least with my expectations of of what others are doing in equilibrium?
Yeah, so in equilibrium, it's about expectations and self-fulfilling expectations. I'm using some sort of notational simplicity here. When I sort of get to the equilibrium and how we're thinking about it, maybe we can revisit this question. Yeah.
Okay, and just the benefit from going with somebody that has skills in that area, irrespective of whether others go there, is that present too?
So right now the brokers are symmetric, but we could have the brokers being heterogeneous as well in this framework. I'm going to talk about the simplest, like, very symmetric thing and what we can get from that. I think it would be these are extensions that we can look at and we have also looked at, but I'm not going to talk about in this presentation. But you can imagine that if the broker is already particularly skilled, you will cluster even more. But we're going to show that there'll be segregation even if the broker is identical to begin with, just because I expect, as your intuition says, so I expect other funds to also go there, or historically just so happened, the first convertible arbitrage fund went to some broker, then the next convertible arbitrage funds that come along will get specialization benefits from going there. So there's some path dependence and sort of self-fulfilling expectations to this. So
No,
it's
you have
a
multiplicity.
Dybwig type equilibrium here. Okay, coordination problem here. I've already shown these figures, so let me quickly go. So the payoffs depend, or the utility depends on the allocation. And so an allocation is equilibrium if no type has a profitable deviation. And so more same-style clustering at a broker raises the marginal return for routing further exposure there. And so there's a strategic complementarity that generates self-fulfilling concentration. So it's a coordination problem along the lines of Diamond-Dybwig and others, and there are multiple equilibria possible. So the realized network depends on history, on like the sort of path dependence and expectations rather than fundamentals. And if you, as Christian was bringing up, if the brokers have some fundamental difference, this would this can also be incorporated. So observationally similar markets can end up in different equilibria. So this is the idea. So to simplify things, let's think about a symmetric quadratic benchmark. So you have the same benefits and the same size between hedge funds and fixed income types. So there are three possible equilibria. Basically, so the fire sale risk from gamma and sort of the concavity of the specialization benefits, it pushes against concentrated equilibria, so either full style segregation or full agglomeration, and then systemic risk deters multi-asset agglomeration, so one broker getting huge. If this is more intuitive, this is showing the same idea, right? So on the y-axis, I have specialization benefits, so this S. And this eta is a parameter that captures broker fragility. So as specialization benefits increase, after a certain point, same style segregation is a possible equilibria. So in this lightest region, only full diversification is a possible equilibrium. Here you can have full diversification or full style segregation, and here you can even have full agglomeration because the benefits. This is where the benefits of specialization exceeds this inequality here that I have. Okay, so you all have brought up different extensions, and I think the framework is flexible enough to we can look into all of these, and we plan to. Kind of two things that we have already thought about or have in this presentation is broker capacity constraints. So right in the baseline, we're not thinking about capacity constraints, but sort of almost trivially, when you have capacity constraints, it pushes against these high concentration equilibria. So full agglomeration is infeasible if, for instance, the broker constraint K is less than sort of the total mass. But in the region when you have this level of concentration, the coordination problem can remain unaffected if multiple equilibria are still feasible. When you have asymmetric specialization, so imagine that the benefits to specialization for fixed income funds, because they're over the counter or because of their collateral requirements or the type of repo borrowing that you need to trade in this, imagine that for fixed income funds, you have higher specialization benefits. This is going to generate asymmetric style sorted network structures where fixed income funds will concentrate into more in their prime broker relationships than equity funds. So in the model, this is what a sort of a capacity constrained allocation will look like. And here you have heterogeneous specialization benefits where all the fixed income funds go to one broker, whereas the equity funds diversify. I have a bunch of stuff on aggregate welfare, but I will try to give you a high level idea. So when you look at the aggregate fund welfare, where I know I saw that 5 minutes, yes. So let's say we sum the utilities or the payoffs across the all funds. What we can find is that, so because there's multiple equilibria possible, the actual equilibrium might not be the social optimal. So because a particular fund does not internalize the impact of their choices on peers at broker J, you can have a externality. So they internalize only their private costs and benefits, and it can generate sort of these three sources of externalities. So the positive specialization externality. So when let's say you are borrowing from a particular broker, it increases the mass at that broker and increases the specialization benefits for all funds. So that's a positive externality. And then there's a negative externality in, first of all, you're increasing sort of the aggregate broker fragility by increasing the total mass. And then the fire sale externality that can come from too much style concentration and having overlapping portfolios and deleveraging and sort of asset losses at the same time. So at one broker, the externality is this. But when you move mass from, say, broker one, broker two to one, you are also changing the sort of the peer effects in the other broker. So the net externality has to account for both of that. The fact that, so you're moving mass to broker J, so the other, the mass is moving out of the other broker. So that's the net externality wedge. Well, all I'm going to say about these figures is, so there are three different figures where we think about, okay, so there are two types. Let's say that all the fixed income funds are in the other broker. And so then as equity funds allocate from 0 to 1, so n here, so the size is normalized to 1, you can have a region where you have you have too little same style clustering. So these green regions are showing that this is where there's too little same style clustering at broker J here. So this is given that the fixed income funds are already all in the other broker. If the fixed income funds have diversified, then that region becomes this. So there is a region where you can have under concentration or under clustering, and here you have too much when you go beyond. And then, so if all the fixed income funds are already at broker J, then any allocation to broker J is going to be, even though there are specialization benefits and that can be an equilibrium, it's going to be in the aggregate welfare reducing. So there's going to be over concentration in any allocation that the equity fund does when the fixed income funds are all already in broker J. So that's from the perspective of what happens to one broker. If you put it together, this is sort of the net externality. So you can have, so you're changing the allocation from, so this is from a social planner's perspective where you see everything. So you can have under concentration in these regions and over concentration here. In the interest of time, let me just say that, so what we do then is we have predictions from the model about who specializes, what happens when either perceived fragility or specialization benefits become more salient. We take it to the data and we think about, so we think about how to think, sort of measure specialization. So this, I think, was the figure that I wished I had earlier, where imagine there's a fund that's trying to, that has the choice of two brokers. There's one fund that has no similarity with your style. Sorry, one broker that has no similarity with your style versus this other broker. So you'd have higher similarity with this broker because of its existing client base. So the way we capture that in practice is we have a vector representation of a hedge fund by strategy or asset allocation. So in Form PF, funds tell you how much of their NAV or their sort of equity is allocated to different strategies. And this can be things like equity long short, global macro, managed futures, credit arbitrage, relative value, special events, and so on. And so this is like I think there's about a dozen that would be the vector representation with strategy. We also have an alternative measure using portfolio asset allocation. Bachimeng is showing me a 0, so I'm going to stop in 1 minute. The asset allocation would be, you can see listed equity long and short, unlisted equity long and short, and so on for all these sort of sub-asset classes. And that gives you an idea about activity in different asset classes, and we can get a vector representation for a fund in that way. So we calculate cosine similarity between a fund's allocation vector and a creditor's aggregate credit base or client base vector. And use Archegos, so it's a very significant effect. I won't have time to talk about the specifications, and I have already talked to you about what we find, right? So yes, there are evidence of specialization benefits because that's sort of like revealed in the network that we see. And after a major shock, there is a supply shock to the connected hedge funds, but the rationing favors high similarity connection, so showing the benefits of specialization. But the fragility risk becomes particularly salient, and the affected funds have lower specialization or similarity in their subsequent credit connections. So to conclude, hedge funds face a trade-off in matching with a broker due to the benefits and costs of specialization. They tend to specialize. They borrow from creditors with similar hedge fund clients. After a major exogenous shock, we find that there's a significant reduction in credit supply, but the rationing favors high specialization. In a simple model, to rationalize these empirical findings, we find so strategic complementarities lead to clustering with funds of the same style, but fragility and fire sale risk push against this concentration. Individually rational choices can lead to aggregate suboptimal outcomes. So there are positive externalities to specialization, which means that markets can even under concentrate. We tend to focus on sort of too much concentration, but this is an example of where this can go the other way. So there's potential role for policymakers to address coordination failure, but naive reduction in concentration can actually be suboptimal. So you need to sort of look at the empirical setting and see what's actually in the data before designing the policy. So it has to tailor these 3 channels of the externalities. And thank you for all the questions and your attention. I'll stop here.
Thanks so much, Sumudu. If anyone wants to ask follow-up questions, we're going to move to the Q&A session.
I do have now at the end still the same question about the similarity. If it's 1, that there's no effect. What is driving that result, right? So you had in the graph now, like a fund, let's say, create a scenario where a fund has only basically identically looking hedge funds. A broker has identically looking hedge funds, and now we add another guy. And that guy is then not affected. They're all not affected if there's a shock to the broker because they're all identical. They have a cosine similarity of 1. Therefore, hitting the broker would do nothing.
Okay, so let me use this stylized example. So even in this, so your cosine similarity with this broker will be 0, right? Because there's no similar style. But here it wouldn't be one, right? Because
I'm creating the
half,
case of one. I'm
yeah.
talking about
So
one though. Yeah.
in reality, we don't have a case of one. So I will start with this. On average,
Let
it
me
is
understand.
like 0.6 at the most, given that, we're talking about very large brokers and, multi-strategy funds. But then, I mean, I'm fine with the interpretation that if you are such a good match, you don't even experience a credit supply shock. So that is the takeaway. If you're a perfect match, you're fully shielded in that. So let's say, so this is public information. Let me go to it's public information that, so from the Archegos shock, it resulted in over $10 billion of publicly disclosed aggregate losses. It affected major creditors, so Credit Suisse, Nomura, Morgan Stanley, UBS, and some others. So what this means is that, so given the choice of, we need to reduce, we have a huge liquidity shock, we need to retrench. I'm going to cut a bunch of folks for which it's not my specialty. I have lower profitability, maybe higher costs to servicing these hedge funds, and I'm not going to cut at all with my perfect match. So this is how we interpret this result. So it's possible that your perfect matches don't even experience a credit supply shock. Marian?
Can I ask? Yes. So I was very much hoping to hear something about diversification. Okay. But I mean, because and there was not a lot of diversification discussion. There was some, but like not a lot of. So the way I was thinking about it, like it's a little too simplified, a little bit more like question. So you have two dealers, right? Let's say there is one dealer in the world. Let's say Planner can come and kill one of the dealers and take everybody to one person. Okay. Does that improve the world?
That's full agglomeration though, right? So that makes this market extremely fragile. So, I mean, if we're going to talk about the model, let me go back. So there you basically have, yes, you have the specialization benefits because all your style is with this broker, right? There's only one broker.
Yeah.
You have also sort of all the fragility risk, and then you have the highest possible, so you have the fire sale risk and the highest possible fragility.
Yeah, but I was thinking that maybe in this case, okay, so one is that you didn't like start comparing your planner, but that's fine. So I was thinking that, okay, so if there is like a lot of fixed income and a lot of equity, okay, there should be some diversification risk here. The broker can be like, not everybody is going to get the same shock at the same time. So when you talk about fragility, I mean, just more similar guys are more likely to get the same shock. So if there's like so dispersed, I mean, just the probability of fragility, extreme fragility falls.
But it does in this setup as well, right? So if you're diversified, that means, let's see, that means, I don't know which slide I want to go to, but this is the thing that is driving. So this is sort of the counter to overconcentration, right? So if the exposure is spread out over brokers, no broker is going to be very big, and so this like if this parameter is very high, it's going to push towards that type of equilibrium. So you have. If I go back to the three possible equilibria, so this full diversification equilibrium, this is when the specialization benefits are lower than sort of this threshold, right? So
that part I understand. That I understand that you're putting specialization against diversification. Okay.
And then the fragility is coming from sort of the concentration in one.
Exactly. That I understand. So my point was more, I think there is a meaning of diversification. Okay. That means like one big dealer. So you are saying many dealers, more diversification. Okay. This diversification at the fund level in a sense, right? Saying that dealer itself can be extremely diversified. If it's one, it can be extremely diversified. So it would never get this huge shock. So it goes pro specialization.
Yes, so you get all the benefits of specialization. You're right. So in that sense, like that's this is that region, right? So you can have basically all the mass of the same style is with this broker. So you have all the benefits of specialization, but you also have maximal fragility risk, right? So this is the full agglomeration equilibrium, right? So you only get it when the specialization benefits are so large, it sort of it can exceed sort of both the fire sale risk and the fragility. So this you're thinking about sort of a full agglomeration.
I'm thinking about something else. I'm thinking about fragility, about diversification and specialization going in this exact same direction. You're always putting them against each other.
I think is what you're saying, Miriam, something like there should be a benefit to having a strategy that sort of is negatively correlated with another strategy.
Yeah,
and that's not really
exactly.
Oh,
So you
I
can
see.
get you have
Okay.
the gains to specialization. That's a different issue. But there is gains exactly.
Okay.
That's exactly what
this
I'm
is something.
Sorry, thank you.
So the fact that but the idea is like, so let's say JP Morgan is this broker that has there's no other broker, and all the hedge funds are serviced by JP Morgan. What we wanted to capture with this framework is just the idea if JP Morgan, then suffers a shock, that's going to be extremely destabilizing. But I think then your point is more about how the styles relate to each other, which is not part of the framework. I see what you're saying. Great.
Okay. Thank you. Sorry.
No, I got it. Yeah.
So, can you talk a little bit more about the externality, where exactly the externality is coming from? So, what exactly is the fund is not really internalizing when making its decision?
Right. Okay. So let's say that there's a fixed income fund that now chooses to borrow from this broker. They take as a given the mass, and they don't internalize as the fact that they also increase the mass, and hence the specialization benefits and the fire sale risk and the fragility cost. So
I guess your gamma on your notation there, so if I'm not mistaken, is
so all three, right? So when you connect with the broker, you change the mass at that broker, but the fund is on when the sort of one fund or for one unit of exposure, you're making this decision, you're only sort of internalizing you're taking the mass as a given and not taking this sort of second order effect of the fact that you are changing the aggregate mass.
So go back. So go back one slide, I guess, on the welfare. So because the fund is when it's deciding the export, it doesn't take into account its effect on the B's, and it doesn't take into account the big M, the MJ. So that I can see, but why it doesn't internalize the output?
No. It takes into account MJ, right? Because it's part of the utility function. It's not taking into account, like, let's say I'm now borrowing $10 more exposure. This $10 changes the specialization benefits. So this choice changes that broker.
Can I ask just notation wise? I think it's related to my question actually earlier on MIJ, the small MIJ. I think this is now, if I understand it correctly now, the total mass, and I'm as a fund atomistic.
Yes. Yes, you're right.
Rather than me picking MIJ. I'm not picking MIJ. MIJ is the aggregate mass, and these are atomistic funds. I think that's maybe
that's I had this written somewhere.
Yeah, and I think that's what really what I was thinking. Like if you are choosing that thing, like you would internalize at the margin how much more you're putting there, right? So the point here is that no, this is just an extensive margin decision. So you're not choosing the M. So this is just the masses at the end of the
So we have atomistic allocation to broker J. So the fund is only internalizing their private costs and benefits. They're taking the mass at that broker as a given. Both the same style and the aggregate mass as a given, but it changes their choice changes the benefits and risks.
Wait, just to clarify, is in the model a discrete number of hedge funds or a continuum?
We interpret it as a no, it is a continuum. Yes.
It is a continuum.
Yeah. And then we're interpreting it as like how much of the exposures, like total exposure of that style, so that we can still have sort of hedge funds connecting to multiple brokers. One fund, yeah. Very good.
And then, okay, if nobody else asked, then I'm still curious about the similarity. Is that that's a result that has nothing to do with your model, right? I think it has to do with the purely empirical part. If the cosine similarity is one, there must be something. Is that by construction exactly zero effect, the way you write down the test or the estimation, or is it approximately zero?
Approximately,
it's approximately zero.
Yeah.
Okay, so it's not by construction of the way you set up the estimation that it just has to be zero, basically. There's something in there. Okay, and then I can sort of see
that I could not show you. Yeah.
Okay, and I can sort of see your argument that if you were to rank your clients by how much you like them, right, you can easily come up with a situation that if there's enough heterogeneity, if they're not identical, that you cut first the ones you least like, and if it happens to be that the ones that are closest to your average guy, that those are the ones you like the most, which I don't know why that necessarily would be, but if that's the case, then I can see the empirical result in that.
So average guy. Yeah. So, I mean, we're using that as a measure of that broker's sort of specialization in that area, right? So it's not like, I guess I have to think about your sort of take on it. We both take the average and the weighted average by how much, activity a fund a broker has with a particular fund. It's just, yeah, I mean, I guess the alternative is no, I can't see an alternative, right? Because it would be a wrong thing if I take the fund. I want to see how much of my highest similarity funds are with the broker. No, this is a good measure, Christine. I'm going to defend it. Yeah. All right.
Can I ask one? Talking about the externality. So your hedge fund doesn't internalize all the externalities, but like the broker in principle knows that at least the externalities within their own relationships, right? Like, so you could imagine, I think you don't have pricing here, but you could imagine the broker setting up a non-linear price or something.
This is a great point. So, I mean, it would have to be a kind of a very special type of pricing because so some of the risks are only to the fund, and it's like risks that broker doesn't want to care about necessarily, right? So for instance, you can imagine the fire sale risk only hits the funds, right? So the fire sale externality is like not borne by the broker, and so the broker has no incentive to price that away in their pricing structure. And then, like, I guess initially I was like, okay, would they to correct the specialization benefit externality, the positive externality, they would have to sort of give a subsidy for specialization. And I guess our empirics are sort of finding that in that they do favor in the credit rationing. But it would have to be sort of very complex pricing structure to fully correct the externality. Because some of these sort of costs are not like the broker doesn't necessarily care about. So.
Like this in the model, like when you look at the data, in principle, the relationships that you observe already include any price arrangement that they have in the data. It's already included there, right? So in principle, the data, you're interpreting this data with this model that doesn't have a pricing, but in principle, the data may be the outcome of an allocation with price distortions to capture some of these externalities.
Yeah, I mean, certainly the model is stylized, but I think it sort of, at least I gain a lot by thinking about it this way. One thing is that so when you said this, I was gonna say something about what we see in the data. I mean, we do see pricing, and then what was the first part of your question? Sorry.
No, it's like the allocation in the data, because as you point out, that I think is kind of a good indication that this happens.
So,
like when there is a shock, they ration. So maybe they also use a price schedule to ration even before the shock. As a test, if the model makes sense, I think it doesn't really matter. But if you're trying to do anything,
I think we can.
It's kind of hard
so we're really abstracting away from sort of the broker's preferences right now, but we can certainly think about that side as well. One thing is, I mean, clearly there are lots of frictions that we're not modeling, right? So some brokers might have sort of too big to fail guarantees where they don't care about their own fragility or fire sale risk because they know they have a backstop, whereas it's not the same for hedge funds because they don't have a backstop or too big to fail guarantees. And so that can, again, make the externalities persist where, they're not going to correct for the higher fragility or fire sale risk.
All right, so I'm gonna end the webinar formally, but I'm still gonna keep the window open, so feel free to stay on and discuss more. But I'm just gonna stop the recording at this point.
Okay, thank you so much. Yeah.
Thank you so much.
Thanks for all the questions. Yeah.